I'm happy to have you here in the studio, virtual studio, Julia. Who of the attendees did already trade in products from Vontobel, for instance, via Maxim or other brokerages? Because I know that for Bink, for instance, it's not possible to trade in turbos and certificates. I'm just curious if because we also put the turbo trade of the week. Also, one of the bingos was Facebook short and went down again. And well, actually, the setup of today, the lineup is first Julia will start, will kick off about 20-30 minutes maybe, Julia, and also Harry will join after that, and also I will round it up. I will finish, and of course, feel free to ask some questions. And we're happy to answer them, and I will soon drop a link for if you don't have already received the turbo trade of the week, and then you can also subscribe. So, Julia, I would like to introduce you, or you can introduce yourself better, of course, and would say the floor is yours. Welcome.
Okay, thanks a lot. So I'm Julien Leroy. I'm working for Vontobel for the distribution of exchange-traded products, and I'm in charge of the Dutch market. We already did in July and August 2 webinars about the turbos, and today we're making a webinar about the BullBear certificates. So let's start with it. So first, a little word about Vontobel. We are a Swiss bank and almost a century old. Our headquarters is located in Zurich, but the activities for the European Union are run in Frankfurt and Germany. We are present in the Dutch market since 2017 for exchange-traded products, so turbos and BullBear certificates. And we are also present in other European countries, so Switzerland, of course, Germany, France, Italy, and the Nordics. Vontobel is an independent bank, and we are not only doing exchange-traded products, but we also have other products for professional investors and institutional investors also. We also have other offices, not only in Zurich and Frankfurt, but also in London, Hong Kong, New York. So we are a little bit all around the world also. So now let's start with the product presentation, so the BullBear certificates. So first, we'll talk about the main characteristics of the product. So now it goes. So Vontobel issues Bull certificates. So the Bull certificates are the long one, and Bear certificates, which are the short one, on a wide range of underlyings. So you can find products on indices, such as the IAX or the DAX, for example, on stocks. We also have products on oil and precious metals. A quick reminder, a product is said to be long when its value increases when the value of the underlying asset increases, and a product is short if its value decreases when the price of the underlying increases, and the value of the product increases when the price of the underlying asset decreases. BullBear certificates are also often called constant leverage certificates, so CLC. And in this presentation, we'll use like both terms, so it's good to know the other name also. One of the main characteristics of these products is that they are leverage products. So it means that if the return of the underlying is positive, for a long certificate, you're going to have an even higher return for the product. For short certificates, when the return is negative, then you have positive return, which is greater than the absolute value of the return of the underlying asset. Of course, Leverage works also in the other direction. So it means that if the price of the underlying is moving in the wrong direction for the product, then your loss are going to be greater in terms of percentage than with a direct investment. So now the main characteristics of the BullBear certificates is that they are open-end products. So this means that the product has no maturity date and it can potentially exist indefinitely. Then the other characteristic is that these products have no knockout barrier. So it's a huge difference compared to turbos. The turbos, they have a knockout barrier, and when it is reached, the product expires. With a constant leverage certificate, you don't have this type of barrier. Also, an important characteristic is, like for all exchange-traded products, there are financing costs related to it, but they are not directly paid by the end investor to the issuer, but they are passed on daily on the value of the product. So in the end, the investor is not paying directly the issuer of the product. Constant leverage certificate have a barrier, but it's not knockout barrier. This barrier is designed to slow down the loss of value of the product if the underlying asset is moving in the wrong direction for the product. We'll see a little bit later how this barrier is working exactly, because it's an important feature of constant leverage certificates. Then another characteristic of the product, and it is also a big difference compared to turbos. The price of a constant leverage certificate is intraday. It is not path dependent, but on a longer period, if you consider several days, it is going to be path dependent. So now we're going to see with a few slides what it means for a product to be path dependent, because it's really an important characteristic of these products. So a financial product is said to be path dependent if its value is not only depending on the current value of the underlying asset, but also on the previous values or some of the previous values of the underlying asset. So to show you what it means concretely, we can consider the following example. For example, we toss a dice 5 times, and then we get the value of the 5th toss multiplied by 10, and this amount in euros. So we can consider the 3 cases in the table there. In case 1, we have, for the first toss, we have 6, then 2, then 3, and 1, and then 4. So here we get 4 times 10, and we get 40 euros. For a second case, we have only 6 until the 5th toss, and then a 4. So we get also 40 euros. In the last one, we get 1, 4, 3, 5, and then 4. So here we also get 40 euros. So in this case, what we get is only depending on the result of the last toss. All the tosses before, they do not matter here. So here we do not have path dependency for the outcome of this game. But it is not always the case, and some products can be dependent on what happened before. So now if we change a little bit the rules here, we still have the 5 tosses, and the outcome is a little bit different here, because we take the average value of all the 5 tosses and then multiply it by 10, and we get the amount in euros. So here in the first case, we get an average of 3.2, so 32 euros. In the second case, we get 56 euros, and the last one, we get 34. Here in this case, the outcome is clearly going to depend on every single toss, not only on the last one. So in this case here, the payoff is going to be path dependent, because every single previous toss is going to have an impact on the final outcome here. But path dependency, it does not necessarily mean that the price of the product is dependent on all the previous prices of the underlying asset, but it can also be dependent on only some of them. So again, if we change a little bit the rules and we say that the outcome here is only going to depend on the average between the value we get on the third and the fifth dose, here the outcome is going to be different compared to the previous example. Here we get 35 euros in the first case, 50 in the second one, and again 35 in the third case. Here the outcome is only depending on the third and the fifth dose. The rest doesn't matter, but still the outcome is depending on what happened before. So we also have path dependency here, and BullBear certificates, they have this type of path dependency. So the price, the value of a bull certificate or bear certificate is going to depend on the value of the underlying at some previous times. So this is what we're going to see after with the pricing of these products. So here we will first explain you the general principle of the certificate, so how it works, and then we'll see the formula for the pricing. So a bull certificate is working as follows. You reinvest every day the value of the certificate at the valuation time. So the valuation time, it's the moment when you are doing this process. So you reinvest the value of the product in a long position with leverage on the underlying asset. And every day you're going to repeat this. So at the next valuation time, on the next day, you're going to reinvest the value of the product at this time, again, in a long position with a leverage, which is going to be equal to the factor of the bull certificate. For a short one, it's the same process, but you're going to enter into a short position on the underlying asset. So the factor of bull certificate or bear certificate, it's the leverage of the product. For the valuation time of the product, it's going to depend on the underlying asset. It's the closing time of the underlying. So for European stocks or indices, it's going to be 5:30 p.m. And for the US, it's going to be 10 p.m. Just to give you an example of that, if we consider a bull certificate on DAX with a factor of 10, so it means a leverage of 10, and we suppose that it quotes at 20 euros on valuation time, so at 5:30, then what happens is we take these 20 euros and we reinvest these 20 euro in a long position with a leverage of 10 on DAX, and this is going to be this position is going to have the same value as a bull certificate on the next day. And the fact that you are reinvesting the value of the product every day in a new leverage position, this is what is going to lead to path dependency, because the value of the product, it's going to be equal to the amount, to the value of the product on the last valuation time, multiplied by the leverage component of the product, and so far and so on. So the value of the product at the last valuation time is going to depend itself on the value of the product at the valuation time before, and continues like this. So now a little bit more about the pricing of the product. What we do at Vontobel, we're not directly pricing the bull or bear certificate directly with a leverage in it, but we are first computing a leverage index if it's a bull certificate, or a short index if it's a bear certificate. So this index is going to be computed as follows if we are ignoring the financing cost of the products, and also if it's a stock, if we're not considering the dividend. The exact formula is a little bit different, but this really shows the principle, and this is clearly going to be the part which is going to have the most impact on the value of the product. So it's exactly as described before. the value of this leverage index or short index, it's simply the value of the index at the last valuation time multiplied by 1 plus the factor times the return of the underlying asset. And the return of the underlying asset, it's the return between the current time and the value of the underlying asset at the last valuation time. So it's not the return of the underlying asset, for example, between the current time and the opening of the underlying. It's the return compared to the last valuation time. And of course, for long product, the factor is going to be positive, so that the return of the product is greater than the return of the underlying asset. If the underlying moves in the good direction for the product, you're going to have a profit. And then if it decreases, then you're going to make a loss on the long product. For a short product, it's going to be negative, so that the value of the product increases when the return is negative, and that the value decreases when the return of the underlying is positive. So then the price of the constant leverage certificate is just going to be this index multiplied by the parity of the product, if it's an underlying quoting in euros. So the parity is just the number of units of index that you are using to price the product. So for example, if you have a constant leverage certificate with a parity of 0.1, it means that you are using 0.1 unit of index to price the product. So why are we doing this? Why it is not always 1? For example, if you have a product whose value increased, which means that the underlying index increased, and let's suppose it quotes at 100 now. What we can do is we can issue a second product on the same index, but with a lower parity, for example, 0.1, and then the product is going to quote at 10, so it's more affordable for retail investors then. But we don't have to compute then a new index. And of course, if the underlying is quoting in a foreign currency, then you have to take into account the exchange rate. So you divide by the exchange rate with which is considered as €1 against X units of foreign currency. So you bring back the index value, which is in the local currency, to euros. If you want the exact formula of the computation of the index, you can find it on our website under the following link here. And you then have the exact formula with the impact of dividends and also the financing costs are described in it. As I said previously, constant leverage certificates have a barrier, which is not a knockout barrier. And this barrier is designed to slow down the loss of value of the product if the underlying moves in the wrong direction for the product. Also, this barrier ensures that the value of the product is always positive. This means that you're never going to be in the situation where you have to pay something to the issuer because the value of the product is never going to turn negative. So the level of this barrier for Vontobel constant leverage certificate, it is set so that it is triggered when the product loses about 80% of its value compared to the last valuation time. So for example, if we take again a bull certificate on DAX with a leverage of 10, and if we suppose that DAX is currently quoting at 50,000 points at the last valuation time, then the barrier is set 8% lower. So it's going to be equal to 13,800 points. And if DAX reaches 30,800 points, it means that the product has lost 80% of its value. And of course, this barrier is recomputed every day on the valuation time of the product, so that we always have this difference, so that it's always remained the same and that the losses are not greater or smaller when it's triggered. So what happens when the barrier is reached? There is a new valuation time. So the process, which we described a little bit earlier, of reinvesting the value of the product in a new position with leverage, this is going to happen. So we take the value of the underlying of the leverage index, if it's a long one, short index, if it's a short product, and we reinvest it in a leverage position in the underlying. And then, again, it's the same, the performance of the underlying, which is going to be used to price the product. It's going to be the performance compared to the price of the underlying at the moment the barrier was reached. What we also do is we recompute a new barrier, and then the next valuation time, it's going to be the regular one if the barrier is not reached before. If the new barrier is reached, then we repeat this process, and so far and so on. So here, I give you an example to show you how this barrier works and how it is affecting the price of a constant leverage certificate. So again, we suppose a constant leverage certificate long with a factor of 10 on some stock X. And we suppose that stock X was quoting at 100 euros on the last valuation time, and that the product was quoting at 10 euros on the last valuation time. And we suppose that at the next valuation time, the stock price has decreased to 90.5 euros. And if we suppose that there is no barrier, we're going to have the following situation. We have a stock performance which is going to be minus 9.5. So with a leverage of 10, we're going to have a 95% loss, and the final value of the product is going to be 0.5 euros. So in the second case, we suppose that we had first a barrier equal to 92 euros. So here we have to separate in two parts. So the first period is going to be between the valuation time and the moment at which the barrier is reached. So what we have here, it's the stock price was initially 100, then it reached the barrier. So the stock performance was minus 8% for this period. So the product with a leverage of 10, it loses 80% of its value, and it's only worth 2 euros now. Then you have to consider the other part, so the time between the moment the barrier is reached and the next valuation time. So here we consider as an initial stock price the 92 euros, and we suppose that the stock went down to 90.5 euros on the next valuation time. So the stock performance here is just going to be minus 1.63. So the product performance is going to be minus 16.3. So the final value of the product here, it's going to be 1.67. So it's going to be higher than without a barrier. So in the first case, you had the negative performance of minus 95. And here with the barrier, it's not great, but it's a little bit better. Here in this case, we have only minus 83%. So also without the barrier, what could happen is if the price of the underlying decreases by more than 10%, the price of the product would be negative. But with this barrier, it's not possible that it turns negative. On the other hand, because the reinvested capital is going to be smaller, if the value of the underlying increases, the price recovery is going to be slower. So now to give you an idea of how the price of constant leverage certificate can move, we'll show you some different cases. There is the positive case, which is if we consider a bull certificate, the positive case, it's clearly going to be positive market trend, but you have to make the difference because if there is a high volatility, it's not necessarily going to be the same as with a low volatility. Then we're going to see some examples of what happens in a sideways market. So if there is no positive or negative trend, and consider an average volatility, and then negative scenario with a negative market trend and an average volatility. So in this case, we're going for these examples, we're going to consider bull certificate with a factor of 10, quoting initially at 15 euros on some stock X, and we suppose it initially quotes at 50 euros a stock. We also set the barrier at 92% of the underlying price at each valuation time. So it's triggered when the underlying price decreases by 8% or more. So it means an 80% loss of value for the product. So bull certificates, they work best when there is a clear positive market trend and also low volatility. Here in this case, what we see is the stock was initially at 50, and then at the end of the period, which is 10 days, here it closes at 60. So it's 10 euros higher. You don't have a lot of movement here in this stock X, but it's always, most of the time, it's positive. So what you can see is when the value of the underlying increases, you have the increase in the value of the product. Then you have a phase where it decreases a little bit, so the value of the product decreases, and then it increases again. So the value of the product increases again. And with the fact that you are reinvesting the value of the product in every day in a new position with leverage on the underlying asset, you're going to have kind of exponential growth because you're going to use the profits of the previous day. They're going to be reinvested with the rest of the capital you previously had. So you're going to invest even more money in the new leverage position. So it leads to this type of exponential growth. And in this type of market situation, bull certificates can perform pretty well. So now we still consider a positive market trend, but with a high volatility. So here in this example, it was for the computation, it was a volatility of 40, which was used, so very high volatility. And what happened here, you still have the stock increasing from 50 to almost 60 euros, but you have a lot more movement here. So you have phases where it increases quite a lot and phases where it decreases quite a lot. At the beginning, it increases, so the value of the product is also increasing. But then it drops quite sharply, and the barrier is reached. So there is barrier event, and the value of the product at this moment is going to be reinvested in a long position. But when the barrier is reached, it means that the value of the product decreased by 80%. So the reinvested capital is way smaller then, and that's why the price of the product is not recovering after that, because the reinvested capital is going to be way smaller. But then it's still working the same way. You can see the stocks increases, and the value of the product after the barrier event increases again. But then you have again these decreases, which are leading to a smaller capital being reinvested. So here you clearly have an example of the past dependency, because you have an underlying whose value is increasing by 10 if you just take the first moment and the last one, but the value of the product is decreasing. And this is really related to the fact that you are using the previous value of the product and reinvesting it. And here in this case, at the valuation times, you often have a lower value which is going to be reinvested. So it's a kind of worst case scenario when you have a positive market trend here in this situation. So now an example about sideways movement. So here you don't have the stock moving a lot, but you have a phase where it first increases, and then you have a long phase of decrease. So the value of the product is going to decrease, and the reinvested capital is going to be smaller, and then smaller again due to the decrease in value of the underlying. And that's why the value of the product is going to decrease in this market scenario. But again, this is not always what is going to happen in a sideways market. You can have situation where the value of the product is not going to change a lot, or even increase in some cases, because it's really going to depend on how the underlying has moved during the whole period. So not only at the end of the period where it is. So here in this case, you don't have a lot of movement in the underlying, and then you don't have a lot of movement in the product price. Have a phase where it increases and then it decreases a little bit, but there is no sharp decrease in the underlying price. No barrier is reached. So the value of the product is mostly remaining constant after the first increase and decrease. So now we will consider the worst case scenario for a long product. So it's a decreasing market. So as expected in this case, the product, since it's a long product, it's not performing well. And every day you have the underlying price, which is decreasing. So the reinvested capital for the bull certificate is getting smaller every day, and you have an exponential decrease in the value of the product. So it's it's the opposite of the first scenario we considered here. Of course, if you take a bear certificate, it's going to be the reverse. For a bear certificate, it's going to be the best scenario, and the positive market trend is then going to be the worst one. So now just a very quick word about replication. So replication, it means creating a position with other financial instruments, which is then going to have the same value as the product you want to replicate. So it is possible to do this with bull and bear certificates. Replicating a bull certificate, it involves borrowing money to be able to have a leveraged position, and this borrowing is going to lead to financing costs for the product, and that then passed on to the final investor. For the process, it's exactly the same as describing the pricing part of for the product. For bear certificate, it then involves short selling underlying asset, and it's going to lead to costs also, and they're passed on the investor. So what happens when Vontobel is selling a constant leverage certificate? Vontobel is replicating the product to cover its market exposure. So what it means is we are not taking the opposite position to the investor. So potential profits of the investor are not losses for Vontobel, and potential losses for the investors are not profits for Vontobel. So now 2 slides about the risk and benefits of the product. So starting with the risks. So of course, there is the risk related to leverage. So due to the leverage of the product, you can have great losses if the underlying is moving in the wrong direction. You have the risk of loss of capital and possible total loss of capital. This is due to the structure of the product. So it is possible that the value of constant leverage certificates gets to zero at some point due to this to the pricing structure of the product itself. If you are trading products on an underlying quoting in a foreign currency, you're going to have a foreign exchange exposure. So this may also affect the value of the product, and if the foreign exchange, if the exchange rate is moving in the wrong direction, you may lose some money due to that. You also have the risk of issuer default. This is true for all issuers and for all derivatives product, not only for bull and bear certificates. And because it's an open-end product, you have the risk of termination of the product. Under some circumstances, the issuer may terminate the product. It is described in the base prospectus of the product, so it's really just under some very specific condition that it can be done. For example, if the underlying is not quoting anymore, or if it's forbidden to quote products on some underlyings, then we have to terminate the products. Now we will see the benefit part of the BullBear certificates. So the benefits is it allows you to enter a position on a wide range of underlyings, so stock indices, commodities. Also, with the bear certificates, you are going to be able to enter short positions on underlyings, and this is usually quite complicated for retail investors without using derivatives. Then you have the leverage. If the underlying moves in the good direction, you're going to make potentially interesting returns with these instruments. Also, the maximum loss is limited to the initially invested capital. So if you buy a constant leverage certificate, you know what is the worst possible outcome. It is you lose your entire capital, but no more. Also, these products, if you buy them, then you don't have to add any further capital to keep your position open. So it means you're not paying anything to the issuer after having bought the product. And now the last slide. It's about the regular valuation times of the product. So as I already mentioned, for European underlyings, it's going to be 5:30 p.m. For US indices and US stocks, it's going to be 10 p.m. And then for metals and energy, so silver, it's 1 p.m., gold is 4 p.m., and for oil, it's going to be 8:30 p.m. So these are the moment used to for the valuation of the product. And of course, you can find all our products on our website for the Dutch market. And on this website, you're going to find all the legal documents and all the information related to these products. If you have any question about the Vontobel products, you can write us an email at the email address here, or you can also phone us if you have any question.
Yeah, thank you very much, Julia. I see that one question of Joop of the Mill, Joop van der Molen. He says that the past dependency. Could you please clarify a little bit that term?
So it was what I showed you on the slides with the tables with the Geist sources. So past dependency, it means that the value of a financial instrument is not only going to depend on the current value of the underlying asset, but also on on the previous values of the underlying asset, or some of the previous values of the underlying asset. So this is what happens with bull and bear certificates, because every day you are using because the value at the current point is going of a bull certificate or bear certificate, it's going to be the leverage part of the product multiplied by the value of the product at the last valuation time. So the current value of the product is going to depend on the value of the product at the last valuation time. And this value of the product at the last valuation time, it is going itself to depend on the value of the product at the valuation time before, and so far and so on. So this is what is going to lead to path dependency. And with the price evolution examples, you could see that in the case with positive market trend and high volatility, because in both cases you had an increasing stock and closed almost at the same price, but the value of the product was very different, because the value of the product depends on what happened between these two moments.
Okay, very yeah. Thanks very much for your good answer. And would like to pass over the mic to Harry Clip, and he's of OptieAcademy. And Harry, the floor is yours.
Okay, yes, good evening, ladies and gentlemen. I hope you hear me properly. And yeah, I switch in the other chair of Jan Robert, where you see us, I hope, also on the picture. We were not straight from the option floor, but our jackets were, that's for sure. And yeah, if you see the old times, you can see it on this picture. I've been a trader from 1990 till 2004, so 14 years. And yeah, some people say you can count them double as a trader because, yeah, as you understand, maybe it can be really hectic. And so I don't have many hairs left, you can say. Okay, let's continue how it is now. Now it's more or less a joke because you can see we don't need 48 screens. There's 3, 4 real screens, and actually I use even less. Okay, what is our program? Yeah, as Julian already said, there are two ways, the long and the short, the bull and the bear, how you call it. And it's my task to take the first one, the turbo trade long. And yeah, I found interesting stock. Probably you know it already. It's on the Dutch market. It's Prosus. And yeah, I want to give you an example. Of course, I have to say it's for education only. And yeah, you can think how it goes from here. Yeah, we would like to give you example. Yeah, that brings us to our mission and disclaimer. I keep it short. You can read it. And yeah, so we are not responsible for any loss you might have. And yeah, the prospectus you could find in certificates.vontobel.com, as Jan Robert already put in. Okay, let's bring it to the next sheet. Yeah, really short. Yeah, we are existing this year 10 years. Option Academy, or in Dutch OptieAcademy. And yeah, we like to help beginning and experienced traders and investors. And we do that by coaching, giving seminars like this, webinars. And we wrote some ebooks. And yeah, we also provide trading weeks. The last one was less than 2 years ago in Cyprus. And we're planning maybe this year or next year a new one. Also, we have to see, of course, what some viruses brings. But let's not talk about that. Yeah, let's give you a trading insight about Prosus. Yeah, Prosus is, I think it came in the indexed IX index less than 2 years ago. And it is, yeah, a huge stock. I just saw the market cap. Even when it dropped a bit lately, it's still above 160 billion. So it is a big one. And I think actually it's the number 3, but doesn't matter. What is the number? It is more important what will be the figures of the stock next month. And yeah, we can say it was under pressure. I will show you in the next one also the graph. And yeah, why I think it's interesting is because it has a big shares program, so they buy a lot of stock. And therefore they take care of, you can say, a bit support in the market. And why they do that? That is because their main focus or their main position because it is an investing company. So they invest mostly in not only Chinese but also other internet stocks, multimedia stocks, and they have also a position in some for maybe some stocks that has no clue with what they're doing mostly, but probably a car brand start also with the T of Tencent. It's called Tesla. They still have around 4% of it, just to give a number. And the famous also Julian knows probably Swiss Bank, UBS. I think even they have now Dutch CEO who came from ING, but okay, that's not the main topic. Is that they just had saying that, yeah, the target is still 85 euro, and I must say I saw also others who has a target of 140. There was another Credit Suisse. What is the cause is that you can of course calculate the assets because they have 30% only in Tencent, and Tencent, yeah, that is a big Chinese stock, and yeah, when you only calculate that, it has already a huge discount. So they have also other assets, as I say, Tesla, even also some game stocks, Activision, Snap, also this music thing. Yeah, I never use it, but for music lovers, they know what I mean. So they have all different kind of positions, and yeah, even today they said they will invest in an Indian stock, Misho. I've never heard of it, but they do it for the second time already, they said, and yeah, they're also with big other companies who deal with the same. So yeah, in a nutshell, we expect a recovery, and therefore we can say we're on the long side of the market. How I get down here? I'm stuck, I think. No, it doesn't work. No. This one, the chart. Yeah. Okay. Let's see the chart. Jan Robert would start with it, but I also look at some fundamentals, and yeah, you can see it is the 1 week chart, and especially you can see that it starts around 70 in middle of 2020, and then yeah, of course it dropped because of the huge drop in March 2020 because of the virus, and then also it recovered really fast. As you can see, it reached this year in March. So in 1 year, it doubled more of less than from 50 to above 100. Even it reached 110, and then it dropped again till today it became 69. And you see it dropped before that level and then jumped 2 times already, jumped really fast from around 67 till around 80. And yeah, it looks like, okay, this can be the third time this can happen. And especially I say that they buy their own stock. I think this can happen maybe for the third time. So therefore, what we can do, yeah, we can buy the best turbo long, and yeah, there is in code, but more important is what is the knockout level, because that's part of the best turbo that you know. Okay, if that level is reached, you've been kicked out of your position. So just above 60, that is, and yeah, there's more or less 13% from today's market. So it also is a ratio from 0.1. And yeah, I think this is a good example how you can benefit if you think, okay, it happened 2 times from around 68, move back to 80, then yeah, maybe it's a good way to benefit from this recovery with this best turbo long. I don't see any questions, and otherwise, because of we have only 10 minutes left, I give the mic to Jan Robert. Okay, thank you.
Thanks very much, Harry, for the very great explanation. Also, the very good trade. Yeah, as you can see, Prosus under pressure, and in my opinion, there's sufficient upside potential. However, the market can stay longer under pressure, of course, than yeah, than it will take. What you think? So that is for the long side, pros long, and always we like to trade in pairs. So one stock long and one stock short, and the next short is from my side is Facebook, and also the people who are also following us, they could have taken this Facebook already short last week or in previous weeks, and they could have gained already. Well, the thing is that Facebook is being hooked a little bit. Facebook is better term. It is being yeah, under scrutiny and also being grilled now by the Senate hearing. And Wall Street Journal also put an investigation in the previous weeks, and it stated even Facebook knew Instagram was toxic for teen girls. And the problem is that in the eyes of the authorities, they say that Facebook was not granted not sufficient privacy protection for the children. So that is also not a good sign, of course. And the Senate hearing today started, and they also stated that weaponized childhood vulnerabilities and making profits of it. That's a shame. And as you know, that of course I'm not pro politics, but in this case I can understand that because you have to protect the children, in my opinion. And one sub-member, middle member of the hearing, Senator Edward J. Markey, he said even IG stands for Instagram, but also stands for instant greed. So this that's very funny, but nevertheless, the market cap of Facebook is a whopping 938.5 billion, and the irony says that they also don't pay dividends, which I could see on Finvis if it's correct. But nevertheless, the stock soared more than 122% since the low of 2020 last year. And from that level, from now on, we expect a small correction or maybe even a big correction. But the thing is that I will guide you through the chart, and that is, as you can see, that from 375 bucks, the market went down, it dropped, and this is a 1 week, so it's better, of course, daily chart, but because on a daily chart, there you can also see a gap down around $360. Nevertheless, as you can see, is around this level, 340 bucks. That is a kind of support level. The next one, the intermediate support level, will be 320, and the next level will be 300. And 300 is also the breakout level from beginning of May. So that's why we have also chosen a very nice Facebook short position. That is the bearish best turbo short. That means that is the barrier equal strike, if I'm right. But best that is that the knockout level is the same as the yeah the knockout level, and the barrier is the same, but that means that if the barrier and the knockout level has been reached, you will lose all the money, and that means that everything what you put in, you will lose. But nevertheless, you can also have the normal turbo shorts where the finance level and also the knockout levels are different, and then you pay a little bit more. But I like this product because I know that, for instance, I buy 100 of these Facebook Shorts, then you put 418 euros on the table. And also, what Harry told that is with the best turbo short is that the ratio is 0.1, if I'm right, and that means that um, you need 10 shares, 10 turbo shorts for one share. And here it is. You can see a very great picture. That means that when the stock price is going up, that means the Facebook is here. The green line, and it went up from first from 20 May 21 around 300 bucks. It went to even 375, and then you see that short is decreasing in value. And the last week it was soaring. We issued this trade out around $3, no, €3, sorry, €3, and now it's around 4. So the position increased already with 33%. And I also recommend always to be not too dependent on of long market. So if you choose some stocks which are breaking to the downside, it's very good that you have some protection to the downside. And always we are looking at long positions as well as shorts. And so that's very nice. And yeah, that is nice how to play the market. Of course, we are also trading options, but the problem with options is that there's an expiration date and you pay a premium. With this turbo short, you don't lose too much when the market is going sideways. So that is very big, big plus, of course. And I don't know who of you did already subscribe um, for our turbo trade of the week. It is here. We'll put it once again for the latecomers, and I will put it in the chat. And of course, if you have some questions, you can type it in the chat or also send it to us. But anyway, what our aim is with Option Academy and also with Vontobel is that the trading is and also investing is not that easy, or not that easy, and we make it easier for you. Like with golf, we make the hole a little bit bigger, that you can um, score a hole in one easier. Yeah, Rich said I can find the turbos on Mixum with the codes. The thing is that with Eisen codes, then you have to call Maxim actually. Maybe also Julian, you can answer this question as well. How to find with Eisen codes with interactive brokers platforms like Maxim. Normally you should have, you should find it, but it's possible that you cannot find it, and then you have to just to take another long or short. But is it correct, actually, Julian, that with the ticker symbols, or with the Eisen codes, you can easily find it? I think so. Yeah. Oh, I see that. Oh, Julian, Julian is not on speaking terms. Yeah, with us, he is on speaking terms. What I mean, he doesn't have the microphone. I will give him the microphone. Julian, if you can switch on the microphone, please. I hope so. Yeah, I hope that you can find it. But and anyway, normally you should find the ticker symbols or the ISIN codes that will be sufficient. And otherwise, go to the web page of Vontobel. Maybe Julian can also copy paste the Vontobel page as well. But that's correct, Ruth. And also with some brokers, it's difficult to find the turbos. Maybe this is also an Very good point, Julian. If you can also ask other brokers to open up the Vontobel certificates and also the turbos. Yeah. Thank you, Ruth. It's better to call Maxim and also to find how to find the others. Yeah. Julian.
Yep. Now I found out how to turn back the microphone on.
Yeah. Okay. Welcome. Yeah.
Had some issues with that. Yes. So to answer to what you said, yes, you can normally find all our products with the ISIN code. It's the international code for financial products, so it should work on by every broker or directly at the Euronext. You should be able to find the product with the ISIN code. The ticker should also work fine.
Oh, there is a mic, I think. Oh, yeah, I see. I hear the mic, I think. Oh, Julian. Yeah. Oh, okay. Yeah. Mic question. Yes. The mic is running again.
Yeah, so you hear me?
Yeah, yeah, perfectly. Yeah.
Okay, so you heard what I said about finding the products, or?
No, no, not now. How to find the products? If you
Oh,
can copy paste the page on it.
what do you mean exactly?
Yeah, where the general page. I will find it for you as well, ladies and gents, and where you can find the products of the BullBear,
Okay, the
the
single page,
turbos.
you mean?
Yeah. The Vontobel page, the general information page. Yeah, because you have also a mailing list where the people can subscribe.
Mm-hmm. Okay, I can send you the link to
Yeah,
the Vontobel website.
thank you. I hope you found it yeah, very worthwhile to watch the webinar as well, ladies and gents, and I hope that you had some insights. So bottom line is as well with the constant leverage certificates that you can also easily get exposure with a certain way, for instance, with the indices, and you don't have to put too much money on the table directly. And but I think that Julian showed you very well that if it's not moving in your favor, then the value can decrease. But the flip side is, of course, when the market is going your way and it's going well, then you can also increase your position in the value. Yeah, Julian copy pasted a beursproduct in vontobel.com that is in Dutch. Thank you very much, of course, Julian, for your presentation, and especially a virtual round of applause of you, ladies and gents, for watching our presentation. And maybe, Julian, you can also switch on your video, maybe.
Yes.
Yeah, and I hope it is not disturbing the bandwidth. And maybe Harry, maybe can also say goodbye to the audience, because maybe yeah, most people they don't know Harry, or maybe they do know Harry, and would like to conclude with the with this evening. Everyone, very good luck, and if you have some questions, feel free to contact us with info@optieacademy.nl or at Vontobel.
Thank you very much for the webinar.
Thank you very much having you, Julian. Thank you for your time. Bye bye.
Bye.
Bye everyone. Bye.